Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. If you're new here, this is a long-term based investment channel, and I just wanted to do a quick video about the state of the market, what I'm doing in early 2025, and my overall investment plan, because I don't know if I've talked about this enough in the past. Sure, I do individual stock videos, but I think it's good for you guys to know what my overall investment ideology is. And again, this is not investment advice. Consult an investment professional before making any investment decisions. So welcome to my investment plan by Internet Guy. And here it is. The idea is to keep it simple. Step one, keep a reasonable emergency fund outside of general investments. I have a job. My wife has a job. The investment stuff is for future money. It's not something I'm using right now to fund my lifestyle. However, if my wife or myself were to lose our jobs, I don't want to have to sell stocks at an inopportune time in order to fund my lifestyle. That's what the emergency fund is for. It's 6 to 12 months of expenses. It's not money I invest with. It's on the side, but it's a key part of my investment plan because, like I said, selling at the wrong time because you have to, not because you want to, is the worst thing that can happen for your overall returns. That's step one. Step two, always invest at least 80% of available investable funds in stocks. This channel is called Time in the Market. It's about staying in the market through good and bad because timing the market is hard, and I'll talk about that in a second. The idea here is that I do have a degree in finance. I do know how to invest. I do have a long-term return track record that's pretty good. However, I know that an individual investor can be pretty dumb, can make the wrong decisions, can make emotional decisions that lead to poor long-term returns. So that's why I've set this thing for myself that says, hey, I'm going to put 80% of my money in stocks at all times, most of it in index funds. And with the other 20%, I can do whatever I want. This is the money that goes towards my individual trading, individual accounts, etc. And maybe some more goes towards individual accounts that stays in stocks forever. But end of day, I'm always at least 80% invested because I don't want to make the dumb decision. I can look at the market today. I can say Donald Jamiroquai Trump is doing a bunch of weird stuff. And I think this is a pretty clear sign of a recession and stocks are going to tank going forward. However, I can be 100% sure about that. And I can be 100% wrong. That's the reality of investing. You can look at what happened in 2008. You can look at what happened in 2020, and you can say, obviously, this was going to happen. I could have called it. I could have seen it a mile away. But could you get back into the stock market fast enough to benefit from the rise after 2008? Can you benefit from the rise after 2020? Or are you going to miss the best days in the market, really impacting your returns? And then three, follow a preset asset allocation and stick with it. Set something you're comfortable with. Do some back testing. Reevaluate it every 5-10 years. I set mine maybe somewhere around 2017. I should probably reevaluate it pretty soon. At the end of the day, this wasn't the most optimal asset allocation now looking back at it, but it was one that I was comfortable with, that I'm still comfortable with, and one that allows me to invest and sleep soundly. That's the important thing. You want to be comfortable with the asset allocation you set for yourself. You don't want to think about it every night and day. Generally, I look at my assets once a month in aggregate, and then I sort of forget about it. I'm comfortable with what I set, and that's the important part. Be comfortable with what you set and stick with it and reevaluate as needed. So why 80%? Well, because timing the market is hard. So I always stay mostly invested. Good days happen in bad markets, and missing the best days is very, very costly. If you look at when the best days in the market happen between 95 and 2024, 50% of them happen during a bear market, and 28% of them happen during the first 2 months of a bull market. So it's really about timing things very well to make sure you're not missing those best days. And if you do, it's very, very costly. If you're fully invested between 1995 and 2024, $10,000 grows to $224,000. If you miss just the 10 best days, that $224K drops to $102,000. Miss the 20 best days, it drops to $60K. Miss the 30 best days, it drops to $38K. And that's pretty obvious. That's common sense. If you miss the best days, you're going to do poorly. On the opposite, and you could say, well, if I miss the 10 worst days, I'm going to do much better. Sure, but good luck with that. There's a reason that most studies show that most individual investors don't beat the S&P 500 average. And the reason is because they don't time things perfectly. It's really all about timing things very, very well in order to beat that market return. And that's really, really hard to do. So here's my asset allocation: 62.5% in US stocks, 20% in international stocks, 10% in real estate, alternatives being maybe gold mining stocks, precious metals, maybe some sort of options plays, maybe some sort of private equity plays, etc. And then 7.5% US bonds. There is no crypto in here. Crypto is like a separate asset allocation I have that I assume is going to go to zero eventually. I do have investments in crypto, but I just treat it as like this is going to be nothing if things go awry. However, it's quite a bit of money at the moment, so sort of is what it is. Sometimes you win with those random side investments you make. Sometimes you lose. That's kind of what happens. And the reason for this asset allocation is because assets sometimes do well and sometimes do poorly. So there's some correlation between assets, some lack of correlation between other assets. And when one thing zags, another thing may zig. So you can kind of see the best return by year from 2010 to 2024. And, sometimes it's emerging market stocks, sometimes it's US small cap stocks, sometimes it's Canadian stocks, sometimes it's US large caps. At the end of the day, US stocks were the best in the last 15 years or so. So you would have been best off just being in US stocks. And the market in general, if you look at this graph that I'll link in the description down below. This was created by somebody called The Measure of a Plan. It's a really nice, cool graph, kind of a periodic table of returns, annualized total returns by asset class. From 2010 to 2024, things have been pretty rosy for investors. 2022, you had negative 20% returns from the major asset classes. But beyond that, things have been pretty easy. You've got REITs doing well. Sometimes you've got large cap stocks doing well. But I do want to go back to 2008, 2009 to sort of show you what a bad market could be like, or even 99 to 2000 and that turnover. You've got 2000 at a negative 12% for US large cap stocks, followed by negative 13%, followed by negative 24%. You've got 2008 anywhere from negative 33% to negative 52% returns for the year, depending on the asset class. That's why you have bonds. That's why you have sometimes precious metals. That's why you have REITs in there to sort of give you some diversification and hope that some of these returns won't be super, super terrible when things go awry. And that's also why I sometimes hold cash. You look at cash in 2008, 2% returns. Cash can be decent when and if you feel like things are just well overvalued. And that's somewhat how I feel right now. But sticking with these asset classes, you got US large cap stocks, US small cap stocks, pretty correlated, but then you got international and emerging market stocks, a bit less correlated. So if you want a bit of diversification, maybe you move into international, maybe you add some bonds, less correlation there, maybe even add some REITs or cash, or if you're a precious metal trader, you add some gold as well. That's kind of what the purpose of the asset allocation you're setting is. And what I did when I set it is basically go and play around with different asset allocations, back test them, see how they were doing. And if you go back test things today, it's going to show you that, hey, you should be fully in US large cap stocks. But obviously, if you are, you kind of see what's happening right now. There's tariffs being placed on various countries. Our relationships with a lot of those countries may not be as great as they were just a couple of months ago. And who knows what that means for future US returns. So maybe having some diversification to other countries is a nice thing to have. So here's my asset allocation in practice, ending at 1.0 because it all adds up to 1.0. You've got bonds in orange, stocks in blue, and my cash allocation in green over here. You can kind of see I probably held too much cash between 2016 through the pandemic. Really, I built some cash up before the pandemic because my whole thought process then was like, oh, this looks kind of iffy. This virus thing, maybe I should be a bit more conservative. Again, market timing can sometimes work out, but also you can sometimes miss out on a lot of returns. I probably held way too much cash here. Probably would have been better off being invested. I was lucky here to make the cash uptick before the pandemic. Then I deployed it pretty quickly once the government just started printing money, and I was pretty cash poor for a while. Then I started selling probably too quickly, missed out on a bunch of returns, and now I'm building up some cash again because of how I feel about the market. There's a lot of uncertainty, tariffs, countries disliking us, Donald Jamiroquai, Trump doing whatever it is he's going to do. He's a bit of a magic 8-ball when it comes to his decision making. Don't love that as an investor. And I certainly want to have the cash there in case some interesting valuations rise up, because I think the market is still pretty expensive right now, and I've talked about that in a bunch of my other videos. Then you have asset allocation and practice part 2. We've got the dollar amounts deleted, but you can see the overall growth of the portfolio is pretty nice. And you can kind of see that, hey, I haven't dropped at all between the latter part of 24 and today, because the stock market hasn't really dropped that much. Sure, certain growth stocks have been punished, but most of my investments have done negative for sure, but not that bad. You can kind of see cash going up in 2020 as the stock market dips, buying more, benefiting from the market rising, seeing the market dip in 22 with those negative 20% returns, then rising again as I bought more. And now I'm sitting in a position where, I do have some cash, but I'm still below the 20% cutoff for sure. Back over here, I was a bit above 20% during the pandemic. That's why I had to deploy cash pretty quickly. That's the nice thing about this asset allocation. If the stock market dips, it's not really market timing. It's like, hey, I'm suddenly above 20% in cash and bonds. I should just buy stocks, because in the long run, that's going to help me get good long-term returns. Because at the end of the day, even if the stock market is dipping today, 10 years from now, it's going to be above where it is today. So if you stay in the market, you're going to be just fine. I just want to have some flexibility to kind of play around with the stock market to, stretch my investing muscle, to use my finance degree, to read some balance sheets, to have some fun. That's what this channel is about. It's not just about long-term investing. It's also about having some fun with individual stock trading. But end of day, my asset allocation is mostly in passive index funds, 55.5% in passive index funds, 27% in individual stocks, then 10.8% in cash right now, 6.6% in bonds right now. So I'm still below that 20% cutoff. I certainly have the ability to sell a bit more if I feel like things are getting bad, but I also will benefit from the upside. If the market just rushes up again, sure, I'm giving up some of that benefit by being more in cash and bonds, but I still have 82% of my money invested in stocks. I will benefit from any upside, but I do have some protection from the downside and the ability to buy things at interesting valuation if the market dips. And as far as the individual stocks go, here are my holdings today. You can kind of see I'm down to about 15 stocks. I've shared this before. In the past, this was like 25 stocks. I wanted to whittle this down. This is separate from that compounders portfolio that I've shared in the past. And you can see there's some international exposure here: Brookfield, British American Tobacco, Genius Sports, NBIS, Sports Radar, but also a lot of US stocks. This is kind of in line with my US asset to international asset allocation. I do have some exposure to those international stocks via index funds, but a lot of it is via individual stocks, because I feel like there's a lot of good values overseas, even now, versus what we see in the United States, despite the recent dip. And you can see I've also sold off a bunch of stocks here. If you compare it to that old video, Apple used to be a 30% holding. I've sold that down quite a bit. I used to have NVIDIA. I've sold that. Mercado Libre, Visa, a couple of other stocks have been removed from my portfolio to kind of whittle it down, but also because I wanted more cash on the side as well. And the reason for that is valuations are still frothy. You look at Costco, which is one of my holdings. I also have it in the compounders portfolio. So I certainly love the company. I think it's a great company, but a lot of its increase in the last couple of years, really in the last year and a half, has been just due to multiple expansion. Yes, the company is growing, but this has been a company that historically traded in that 25 to 35x multiple range, maybe as high as 40, and is now trading at a 50x multiple, down a bit in the last week, but a 50x multiple for essentially a retailer that's growing in the mid-single digits, maybe high single digits on a good year. If there's an economic slowdown, maybe that benefits Costco a little bit because more people shop there. But at the end of the day, it's very, very expensive. And when you look at, hey, this should be trading maybe at a 40x multiple, is actually trading at a 50x multiple, there's a lot of potential downside here. And that's the risk reward calculation you're making as an investor. When you look at the S&P 500 earnings yield, a 3.4% earnings yield when it's historically traded in that like 4.5% to 5% range in the last 10 years. And you look at it today, you look at the potential frothiness in the economy, whether it's the layoffs with Doge, the tariffs, other countries doing boycotts against us, whatever it is Donald J. Trump is going to do in the next 12 months. Do you get worried about buying the S&P 500 valuation that's at a premium of what it has been historically? You look at the Shiller P ratio, trading towards the top end of what it's traded at in the last 20 years. The last time it was trading this much was right before 2022. And guess what? The stock market tanked about 20 to 25%, depending on the asset class you're looking at. So essentially, things are expensive. You look at the tariff wars that are happening. The last one in 2018, the stock market was basically flat to negative for a year and a half after that. Now we've got another tariff situation happening. Now it's not only against China, but it's also against other trading partners, some of our closest trading partners. How is that going to work out? Certainly not going to benefit those countries because they really depend on the stuff they export to us, more so than we depend on them for that. But it's still certainly going to lend some troubles to the stock market. And when you're sitting at multiples that are 20-year highs or near 20-year highs, it gets you a bit worried as an investor. And the risk-reward scenario doesn't look as good as it has in the past. You look at the S&P 500. Yes, it's down a little bit in the last couple of weeks, but it's still trading pretty close to all-time highs. Like I said, only down 1.5% year to date, down a little bit more since all-time highs, but still up 12% in the past year. So overall, it's frothy. What does that mean for me? What's the plan going forward? Well, there's no changes in strategy. I am cash heavy, as I said, which allows me to take advantage of interesting valuations. But the reality is I am giving up some potential gains if the market changes course. If suddenly tomorrow tariffs are all off the table and deals have been made and the Ukraine-Russia war is over and everything is amazing, the stock market shoots up 20%, I'm giving up a little bit of that because I'm in cash, because I'm in bonds. If I were fully invested, I'd benefit more. But because of my other investment ideology, because I'm always at least 80% investment, I still have the majority of that upside, but I benefit from some of the potential downside. And right now, I just don't feel like the risk-reward equation in this market is that great. It's worse than usual. And I feel pretty comfortable with a larger cash pile. So when I look at these PE ratios, I look at the tariff stuff, I look at all the news happening, I'm okay with having some of that cash because if the market drops another 20%, which I perfectly, it's perfectly reasonable, I am in a spot to take advantage of that. And I do have some puts out there as well. I have a put on Kava, for example, stocks that I just think are richly valued in a market that may be correcting on a bigger scale. Puts on some of those stocks, so I think benefit a lot more. But obviously, I'm giving up the upside that exists in the stock market by doing some of these things. And that's perfectly fine as long as I'm 80% invested. I still benefit with the majority of my portfolio from any upside. And I think in the long run, this is a winning strategy because, hey, I get most of the upside. It's something I'm very comfortable with, so I can sleep soundly at night, and that's very important. I'm never going to sell 100% of my stocks. I lived through 2020. I lived through 2008, and I was comfortable with this strategy then. I'm comfortable with it now. So if the stock market drops 50% in the next year, which, again, if we look back to this day a year from now and the market's 30 to 40% lower than it is today, you'll say, obviously that was the case. And that's kind of how I feel about it. I feel like there's potential for this market to correct 20 to 30% from today. But with Donald Trump, the magic 8-ball, you never really know what decision he's going to make. And he could do something that's really beneficial. And maybe in the long run, the things he's doing are going to be beneficial to the United States economy, bring a lot of investments back into the United States instead of those investments being overseas. And that will lead to really good long-term returns for the US. But it may mean some short-term pain. And that's something I want to be able to take advantage of if I'm right. And if I'm wrong, I'll just reinvest the money at a lesser long-term return, but still mostly benefit from the upside that exists in the market today with the fact that I'm 80% invested. So those are my thoughts. As always, not investment advice. What's your plan going forward? Let me know down below and let me know what you think about my investment plan. Is it wrong? Is it stupid? Am I a dummy for doing so? Or is it something that you find interesting? Thanks for watching. Have a good day. Bye.